For more than 2 decades, we've been educating our listeners about financial topics that are most important to you. Do you have enough money to retire? How will you keep from running out of money? What's your plan for managing market risk? What about taxes, inflation, and health care? Each week, we talk with an advisor at Lucia Capital Group about these issues and more. This is Managing Your Financial Future.
Welcome back to the podcast. This is Managing Your Financial Future. Yes, indeed. Another episode here. Johnny Dean, your podcast host. Professor Rick Plum, certified financial planner professional and accredited wealth management advisor here with me as always. I mentioned at the end of last week's podcast, and as I said, I don't usually do that, but I wanted to tease this particular topic because this is something we're going to talk about today that for some reason, Rick, I didn't hear about these things being offered for a long time. And we'll tell you what they are in a second. But it seemed like these, especially the second thing we're going to mention, went away for quite some time. And I was listening to a podcast, actually 2 different podcasts, and both of them had sponsors where they were pitching these particular types of products. Now, we'll get into this second one, as I said, in just a moment. But you enjoy kind of clearing things up, debunking? I don't know. Is that a good word to use?
I like having people understand the truth about things.
That's it. Yeah. Understanding the truth and kind of going beyond or around or destroying what sometimes becomes very untrue marketing for certain financial products. And I'm going to cover these both now. There are 2 of them that I think are often missold, and I think I might have said misrepresented. Would you agree that
I do? I do.
Insurance products are, yeah, and not that they're necessarily bad, but well, let's get into this. The first one is the first one is annuities. Okay, we'll mention that right off, and the second one has to do
broad
with
topic.
Well, but we'll see why in a second. And the second one is we'll get into in a bit, has to do with something called whole life insurance, which kind of is encompassed by permanent life insurance. Again, these are not necessarily bad products. They need to be used properly. Let me start with annuities. They have to be used for the right purpose. We know that. We've talked about products like this, Rick, are being tools.
Well,
they're not
any
magic.
investment needs to be used for the right purpose. You use any investment for the wrong way, and you're going to get a substandard result.
Yeah, exactly. And so I want to break these down in a truthful way. We're going to talk about what they are and what they are not. I think this is a good way to do this, where they can help, where they might cause problems, and where the sales pitch can sometimes sound a whole lot better than what they really are. So annuities, we'll start with that because this is one of those products where people, I think, Rick, tend to land in one of 2 camps. They either think annuities are the absolute greatest thing ever invented, or they think they're complete garbage. So first of all, do you want to just start with just the basic concept of an annuity and explain to people quickly?
Well, unfortunately, the way you're talking about right now makes it all sound like annuities are one thing. Mm-hmm. Annuities are a very broad spectrum of different types of investment and opportunities, benefits, and things of that nature. They're not one thing. I mean, and one of the biggest things that people say is they're loaded with fees. You can't trust them. And you know what? For some annuities, that is a correct statement, but that really is a subset, a fairly small subset. The majority of annuities, especially the ones issued today, that don't have these lifetime income riders, which is a whole nother game, they don't have fees. It's like, there is a fee if you get out of it too early. And this is where I think some of the misrepresentation comes in that if you're buying a 5-year CD, a 3-year CD, there's usually a penalty for getting out of it early. You give up some interest, maybe you give up some principal, but probably not a lot. But with a fixed annuity, if you get out of it early, there's a penalty. It's a much bigger penalty than what you would typically see on a CD, but the same thing. If you don't, you wouldn't want to buy a 3-year, 5-year, 6-7 year annuity that has a substantial penalty for early withdrawal, surrender charge, if you thought you were going to need that money to spend more than what the free withdrawal amount is, in that time period. That's just you don't buy it if you need the money next week.
Okay. Now,
but anyway, there's lots of different kinds of annuities.
Well, okay. Now I'm not trying to group all annuities into one. Obviously, they come in all kinds of different flavors. It's like, what is ice cream? Well, you got 31 different flavors or more. But to me, it just for people that don't know, I think the basic concept of the annuity is that you hand an insurance company some money, then they eventually return that money to you, some of it, all of it, or more than you gave them. Can I sum it up in that way, just for people who don't they've heard the word?
Any investment. I mean, and depending upon what type of it is, there may or may not be a guarantee of principal. Mm-hmm. The one thing that is in common with all of them is that whatever earnings do occur, should there be earnings, are tax deferred, or can be tax deferred until you take the money out later on. Now, that doesn't mean that you should or should not buy one. Sometimes that tax deferral is not good for you.
Well, okay. So how are they we talk about them being missold and sold to the wrong people and misrepresented. How have you seen that happen? What's some of the pitches?
Well, there's a couple of things that I've noticed. And luckily, I don't see it as much today as I saw it 10, 15, 20 years ago. But I still see it to some degree. The fixed annuity, it has a 6, 7, 8, and I would be wary. The longer the surrender period, be more wary of what that insurance company can do to you. Because what they'll do is they'll say, look, we'll give you, I could probably find one that pays me 8% right now, an 8% actual interest rate first year. But I can't get out of it after 1 year because of that substantial penalty for early withdrawal. And it is going to be fairly substantial. And as I mentioned a minute ago, the longer the surrender time period, most likely the larger the surrender period, the charge in the early years. But so the next year, unless I am careful about what I am buying, the insurance company can drop that interest rate the second year and pay me something significantly less, like 1%. 0.5%, or some other number. And then do I get out of it? Do I pay an 8 or 9% charge to get out of it? So you just have to be aware of what's going on. So what they would do is they would entice you with this very large first year rate and then give you a crappy rate for the remainder of the surrender period. And in all reality, you would earn about what you would have earned on a basic, like a high yield money market over the period of time that you were in it. Nothing special. But how would they get you to invest in something nothing special? They make it look really special. They make it look really good. So whenever you're buying something, especially in the fixed annuity world, look at what I call, what is my return to the worst time? What is the worst thing the insurance company can do to me? And if they give me an 8% the first year, but then they can't go any less than 2.5% for the next 4%, and I calculate that out, and I'm getting about a 4% overall rate of return. If that's an acceptable rate of return at the worst case scenario, that's a good idea. I can do that. But if the worst case scenario turns out to be a 1% return over 12 years, that's just not worth doing. And unfortunately, they couch it in such a way, they market them in such a way that they just sound too good to be true. And guess what? They are.
We used to see those. I'm sorry. We used to see those signs too. I would see them back when interest rates were low, and I would see 6.5% or 5.5% in a 1% world. I mean,
right, and you could get that because they would give you 6% the first year. You'd be locked away for 12 years, and you get 0.5% for 11 years. Mm-hmm. Overall, you'd get about what the average rate of return that you would normally expect from that type of guaranteed account to give. Now, typically, annuities, they do not take the place of CDs in the less than 3-year period of time. But in many cases, if you're looking for CDs, individual bonds, or something of that nature that you want to hold for 3+ years, fixed annuities, and you can actually hold them for 3+ years to avoid surrender charges. Fixed annuities will pay a little bit higher rate of return than you can get on other traditional guaranteed fixed products, which is a good thing.
And we've talked in the past about using them as maybe bond alternatives, potentially. Just kind of depends.
I use them as bond alternatives all the time. I use them as CD alternatives all the time for the right time period.
Yeah.
And I make sure that the surrender period is short enough that if I need the money, I can get to it when I need the money. Typical, we go back to buckets. Bucket number one, we want to have 7 years worth of cash, distribution of cash. So very easy math. Let's say I needed $50,000 a year. If I need $50,000 for 7 years, I put $350,000 into bucket number one. Now, do I want all $350,000 of that sitting in a money market account that today is earning 3.5%? No, I may not want to do that. I would probably want to start laddering out maturities on things. But instead of laddering out a 1 year, 2 year, 3 year, 4 year, 5 year, 6 year, $50,000 CD, I may, put the money I'm going to spend over the next year in a money market account, put the money that I'm going to spend next year in a 1 year CD that refills the money market account and for the next 2 years. And then I start with the 3 year time horizon. I use a fixed annuity because it pays more. Not significantly more. It's not like I'm going to pay 10%, but instead of earning 4, I may earn 4.25, 4.5 on that fixed annuity, and use a 3 year for a couple more years worth of that, another 100,000, and then use a 5 year. So you can ladder them out and get a little bit more juice out of that orange.
Now, when I hear you explain it like that, I think, well, you could market it that way. I mean, there's nothing technically wrong with doing it that way.
But it's not sexy enough to bring in the big people, the big numbers.
Yeah. It's you want to see that huge interest rate. You want to see that 8%, whatever that is. Now
the way I just described it makes sense for somebody who's talking about a bucket, who has a plan of action, who has a strategy, that knows what they're looking for. Mm-hmm. But for people who don't have that, and the insurance company is marketing to people that don't have an actual plan, they're just trying to entice anybody to listen to their marketing. They're not going to listen to hey, we're a little bit better than CD. They want to, the person that they're looking for is, oh, wow, I got to have that.
Okay. I could, gee whiz. I remember hearing those marketing pitches. You're right. I haven't seen them as much lately. Now that's on the fixed side. We don't have a lot of time because I want to get into this other stuff too. But do we want to get into the other kind?
There's two other broad categories. One is index. One is variable. The index annuities, they are a form of a fixed annuity. It's just a subset of fixed annuity, but the return can be better or not, depending upon how it goes. Now, with a traditional fixed annuity, the interest rate is stated now. We say you're going to get this for the next year. You're going to get this locked in for the next 3 years. If we're doing fixed annuities, I want to have a fixed rate guaranteed for as long as the surrender period, so the insurance company can't drop it on me. Okay, done with that. With the index annuities, you don't know what your rate of return is going to be because it's based on the performance of an index, hence the name, over the 1 year, 3 year, 5 year time periods that you're dealing with. Then it gets complicated because you get in all these different types of strategies. But the most generic one is you use the S&P on a 1 year basis. You look at the S&P the day you get into the contract, and they look at it each year after that on a 1 year by 1 year segment, and they say, okay, did the market go up over that 1 year period of time? It's not January to December. It's your contract anniversary to contract anniversary, basically. And they say, did it go up? Okay, if it went up, you get an interest rate equal to that positive movement in the index, subject to some form of watering down. It could be a cap, where the cap right now might be 8 or 9%. Or I saw one on the books the other day that had an 11% cap. If the S&P 500 is the index only, now this is not the same as an index fund because it does not include dividends, but the index, if the index is up 5%, you get 5%. If the index is up 10%, you have a 10% cap, you get 10%. If the index is up 15% over that measuring period and you have a 10% cap, you get 10%. You don't get anything more than the cap. The other thing is a participation rate where you only get some percentage of the return. So that's where it gets complicated. But you can probably get a much better rate of return than a fixed annuity, although some years you may get 0 rate of return. The nice thing here, though, is you can't lose principal because you're not invested in the index. You're only invested in an interest-bearing account that receives that pays interest based on the movement of an index.
So you could get 0.
You could get 0 if the index went down over your measuring period. You could get 0. You won't lose principal. Then there's other ones where you can put a buffer on them, but they get carried away, and so you have to understand what you're doing, what you're buying. It doesn't make them bad. They're trying to manage risk in a different way. We've used them depending upon the client, how they want to do it. We see them a lot in bucket number 2, and they work very well. You're not going to get the 20% rate of return that the market sometimes gives you on an annual basis, but you're also not going to get a negative 15-20% that the market can also give you on an annual basis. So it's for different time periods. It's not a replacement for an investment in the market. It's actually another form of a bond alternative.
And again, very quickly before we move on, some do not have fees, as you've said. Certain annuities, others may have a lot of fees, and you just have to know what it is. Variable annuities
typically have the fees now, or when you start adding riders, like these lifetime income riders. If you have a rider on there that says that you can do special things like get a lifetime income, they charge you for that. They're guaranteeing you something, and they charge you for it. Doesn't make it bad. Doesn't make it good. It's just a fact of life. Does it fit in your strategy? They can work very well, and they're very good at helping you control your emotions when it comes to the overall volatility of the market. If you know that you've got a lifetime income of X amount of dollars on top of your Social Security, on top of your pensions, it makes you less emotional about the rest of the market. So they do potentially have a place. The place is not to try to get the greatest rate of return in the world. Yeah. It's not going to give you the greatest rate of return in the world, but it does give you potentially significant amount of peace of mind when you're doing it the right way. Now, variable annuities are basically using a clone of a mutual fund. They call them sub-accounts, and they have fees because they have fees. Now, the internal expense of the sub-account is usually less than the mutual fund, although not less than an index fund, but you get the tax deferral.
Yeah.
Me personally, not a big fan of the tax deferral in that respect because I'm turning a growth in the market growth from a capital gain, potential capital gain, to an ordinary income, and I'm paying a fee for that. So we all have our idiosyncrasies, and I'm not a huge fan of the variable annuity unless you put one of these riders with it that then gives you the ability to be very aggressive and know that your income is still set. So you can try to get a little bit of the best of both worlds.
Yeah, it's kind of a nice thing, especially if you're maybe saving for heirs or something, and it's not money you don't necessarily
maybe
need
not.
Right now.
It depends.
Yeah, but okay, all right. So that's the annuity side. You can see the biggest problem with them is that they're sold as if there's huge interest rates, and
they're sold as if they're the God's greatest gift to you. And they fit in spots. They're niche. They fit in the area that they're. If you use them appropriately, they work well.
Yeah.
But just buying them because they have these great promised rates of return will usually come back and bite you in the butt. That's not what they're for.
But those who hate them usually say, well, because of the fees, massive fees.
But most of them don't have the fees.
Yeah, and the ones that do, as you said, you may want to pay for a feature that will have a fee.
You got to, when you're buying some of these things, I've seen mutual fund managers or portfolio managers say, well, we can do the same thing with a portfolio. I said, well, can you use the word guarantee with that? Because the insurance company is guaranteeing this result. Can you flat out, honestly guarantee? And it's like, well, no, but we can make it happen, but you can't guarantee it. So people who want guarantees can get guarantees from the insurance company. That means use a good insurance company because the insurance company is the one guaranteeing whatever they're guaranteeing.
Well, let's get to speaking of these are both insurance products. I want to get to the second one here that I'm hearing a lot of things about, and again, it's kind of come back up using. I think it's mainly whole life, but the basic pitch is instead of putting money into banks or the stock market, traditional retirement accounts, you put your money into these whole life insurance policies that build cash value over time. Then later on, you borrow against that cash value for whatever you want: cars, emergencies, college, business opportunities, retirement. Whatever you want, while the money inside the policy supposedly continues growing uninterrupted. Now, Rick, the idea, and you know all this, but the idea is that you become your own bank with tax advantages, guarantees, and protection from market volatility. That's the pitch, and it sounds really, really good if you're not knowing what you're buying. Can you talk about...
You know what, John? They work if you do it right. But the way that they're marketed, the way that they're sold is start this today, bank on yourself, and you can be borrowing it tomorrow, within like the next week and a half. Now, these things, they do work. And if you want to do it, but they take time. Mm-hmm. You can't expect to be borrowing money out of it to be able to bank on yourself in the first 10 years, really.
Well, isn't there a fairly good chance in the first at least 3 or 4 years that you're going to be upside down in this?
Oh, heavens, yes.
Yeah.
I mean, there are some that promote themselves as being better, but and you're not going to be able to get all the money out because these things are they can be complicated. They sound really simple, but they can be complicated. And even if you do them right, if you start borrowing too much money out of them later on in life, you can run into a problem where you will lapse the policy. Now, these started off with whole life. Whole life it has the best guarantees in it. It will also give you the lower rate of return compared to some of the other types of cash value insurance. The newer, and I talk about newer being 30 and 40 years old now, variable life insurance, indexed universal life insurance. I mean, back when you were just a teenager or so, you bought a life insurance policy because they told you it was a great savings vehicle. Uh-huh. And you were upside down for a couple of years, and it was very flexible. You could put money in, you don't have to put money in, and that flexibility sounds wonderful. But it's also the worst thing that can happen to you because you end up not putting any money into it, and it falls apart.
That's what I did. I had life insurance, and I said, well, I don't have it. I was like 21, 22. I said, well, I mean, I don't really have the money to pay the premium. It'll pay for it out of its cash value. And I mean, I forgot about it. Yeah, it can be a bad thing. Yeah,
flexibility can be the best thing and the worst thing for some things because we tend to take advantage of it. But I was talking to a gentleman last week who is a perfect candidate for using one of these types of policies for cash value buildup, for retirement buildup, for retirement income. The guy's making well over $1 million a year. Expects to be making more than $1 million a year for the next umpteen years. So he's in a very, very high tax bracket. Now the problem is when he was first approached with this idea, the person was saying, you need $3 million worth of life insurance. And so we're going to sell you this $3 million policy, and we're going to have you put $50,000, $60,000 a year in it, and it's going to grow. This cash value is going to grow, and you're going to do well. No, they don't work well that way. When you're doing it from a cash value accumulation standpoint, you want to have, and this is going to sound weird, the lowest death benefit allowable to maintain that tax advantage growth. Cash value in a life insurance policy grows tax deferred. When you take distributions from that cash value, or you borrow money against that cash value that's paid back when you die from the death benefit, those are all tax free as long as you don't violate the rules, with something called a modified endowment contract rules. So but if you really want cash value buildup, you want to cut the internal fees as much as possible. What is the biggest fee internally on a $3 million life insurance policy? The cost of the life insurance. So what you want to do, and what we helped him do, was he bought a very inexpensive term policy that'll carry him until well after he's retired. And he pays a little bit out of that. And that's kind of like your car insurance that you buy it and you hope you never use it and you don't get any money back from it, if you don't use it. But it's a lot less expensive. And then we ask him how much he wants to put away every year, how much he wants to commit to putting away every year. And he said, well, I can do the $50,000 a year, and that's over and above 401k, over and above retirement plans, over and above his real estate, over and above. And he can commit to it for the next 10 to 15 years. And so we looked at lowering the death benefit as much as possible. And you know what? That we could lower it down to about $600,000. So yeah, he's buying $600,000 of death benefit the first year, but he put $50,000 in, so the insurance company's really not on risk for that much, and so the internal fees are less, and this thing grows pretty well. And when you look at it from an after-tax or a tax-efficient standpoint, it works pretty well because when he's 65, he can start pulling money out of this with 65, 70 for whatever he wants, and then use it however he wants. He can use it as an annual cash flow. He can get, he puts $50,000 in for 15 years. And if he wanted to, he could take the money out until he was age 100 and still have money left over. And he'd be taking like $70,000, $80,000 a year out. And so he liked the idea. And so it's just a matter of it works well for that person. Now, that person is in a very high tax bracket, which makes that tax-favored growth really attractive. He's already maxed out every possible tax-deductible savings available to him, every possible tax-favored savings available to him already. And he has extra money, and he can commit to it for a long period of time. These do not work on short periods of time. They do not work unless you're in the really high tax brackets. They do not work as well as a Roth IRA. They do not work for short time horizons.
Well, and the funny thing is, Rick, I didn't in these ads that I was hearing on these podcasts, the two different podcasts, I didn't hear that mentioned once. They said everybody, at least they implied it. Everybody should be doing this. It doesn't matter whether you can overfund it or not. In fact, they don't even mention any of that stuff.
Well, what really ticks me off is you get a salesperson who is looking, like the gentleman that sold you yours back 100 years ago. Let's say you were newly married, you just had kids, you need life insurance. You don't have money saved very much yet, and if you died, it would be a very big financial burden on your family. So having life insurance makes it's imperative. It's a must do, and you can afford $100 a month, and they sell you a permanent cash value policy that buys $100,000 of death benefit for that $100 a month. Well, $100,000 is not what your family needs. Your family needs $1 million or more. But they sold you a $100 a month policy with $100,000 because they got paid more. If they had sold you a term policy for $1 million, it may have only been $50 a month, and they would have gotten paid a lot less. But it would have been the right thing for you. So they market it to everybody as if it's the best thing for everybody, when in reality, it's the right thing for some people, and it's a disaster for other people because, great, you put $100 in and unfortunately you died, and your family still has a giant financial burden. They didn't take care of anything, but if they'd done it right, they could have.
They call this bank on yourself, and I've heard different appellations.
Well, bank on yourself is all about creating cash, so you don't have to go to the bank, and using tax free and all that. But it takes time. It takes overfunding it. It takes using it efficiently, and that's not how it's sold because that's not how they get paid.
And the funny thing is, when I'm hearing this, you're really not banking on yourself. You're kind of banking on the insurance company rather than an actual bank. So,
and you're banking you could bank on yourself by using mutual funds, by using your Roth IRA, by using other things. It's just this bank on yourself concept was created well before Roth IRAs. It's been around since I've been in the industry, which has been 30 or 40 centuries.
Yeah. So it seems to me that what they're trying to do is take a concept that works for a probably fairly small segment of the population, expand it out to everybody, hope that they buy something that's going to, they want to sell these insurance policies that will give a big commission and to whoever is selling it.
Well, they're trying to sell insurance, and they're trying to use things that people are already freaked out about. Primarily taxes. Nobody likes taxes, and if I can do something tax free, that's so much better. But but people don't know math, and they don't look at it from a rate of return standpoint. They don't look at it as, what am I actually getting back on a tax advantage basis? What is this actually? It's really good for people in this somebody in California that makes $1 million or more, they're paying 37% federal, 13% state. They're paying half of whatever they earn in taxes. Okay, it works for them. For the average person that's making $100,000 to $200,000, it's in the 20-25% bracket overall, 22 here, a little bit that there. It's just not it doesn't make up that much of a difference. I mean, you figure if I'm putting in $50,000 into a straight premium whole life policy that we didn't reduce the death benefit on for efficiency, that broker who sold it to me probably got $30,000. The insurance company had to take something off the top too. So in the first year, even though it shows the money in the cash value, you can't have it. There's a huge surrender charge. Because the insurance company is out a bunch of money. They don't have it in there. It takes time to work back and earn that back. The insurance company is not going to lose money on this. There's three people involved here. There's the insurance company, insured, and the broker. Well, the broker's already been paid. The insurance company is not going to lose money, so who's left holding the bag? If you don't do it right, you're the bagger.
You're the brokey is what you are. It all comes down to understanding what you're being pitched, what you're being sold. And when it comes to these financial products, Rick, if you're just listening to, any podcast or watching TV online, they're everywhere. You got to be careful with what it is you're buying. So you would suggest for both annuities and for this whole life insurance kind of thing, you would suggest that, again, it's not that they're bad. They can work very well under the right circumstances.
Right. And designed properly. And life insurance is a very, very important part of anybody's financial plan, especially the younger you are, especially with young families where you don't have the $1 million 401k. You don't have the assets to back up, what happens if you die. Life insurance is extremely important, but do the right thing and do it the right way so that you're not wasting money.
Yeah, for many
I don't
people,
like to waste money.
For many people, term, I think.
For most people, term is the right, especially young families. Term is the right thing. What I look at is if you can afford whole life, you probably don't need the death benefit as much.
You may be right. That's a good way to look at that. I like that.
If you can afford all the insurance you need, you must have assets or income. Now maybe you're really high income and you don't have the assets yet. No. So that still probably leans towards term for at least some of your overall insurance needs. So why are we buying this? Am I buying this for insurance to protect my family in the event of my death? Am I buying this for death benefit? Or am I buying this as a cash value accumulation tool? Because the way you do it is very different on both of those ideas.
So what are your goals? That's you got an advisor.
What are you trying to accomplish?
An insurance agent should be saying, well, what are your goals in purchasing insurance? Not just come to you and say, boy, this is a great product. Here, let's sign right here. Well, just to kind of wrap this up, I think what I hope we did was take a little bit of mystery out of these products, because things like annuities and whole life and other sort of complicated stuff, they tend to get talked about in extremes. We've said this earlier in the show. They're either the greatest thing ever invented or they're completely dismissed as terrible ideas. But the truth, of course, is somewhere in the middle. You need to talk to somebody who understands how these things are work. How they work. They're tools. They have strengths. They have weaknesses. But there are trade-offs too. And when used correctly, they may absolutely make sense. But there's no magic involved with this. And this is why planning matters so much. Rather than trying to find the perfect product, it's a lot better to know what your goals are. Rick, you just said that. What problems you're actually trying to solve, and then using the right tools to achieve those goals with that specific job. I think
the goal is about how long is it between now and the goal? What is your risk tolerance? What is your attitude? What is your emotional? What is your sophistication? How much do you understand? All of this goes into determining whether the investment is an appropriate investment for what you're trying to accomplish or not. And it's different from everybody because not everybody's the same. It's just you've got to look at why am I putting money into something? I need to have a reason. Is this money going to solve or help me solve that reason that I'm dealing with?
If you want to talk through any of this in your own situation, always talk to an advisor about this, somebody who's got your best interests in mind. Reach out to the team at Lucia Capital Group, 800-644-1150, 800-644-1150. Visit us online as well, luciacap.com. We have guides there. I don't have one on this particular topic, but you heard some pretty good stuff on this podcast. You can learn about the bucket strategy, Social Security, rollovers, estate planning, retirement income. All those guys designed to help you better understand how these different pieces fit together. Just type what you want in the search bar in the upper right, and you can download the guide and read it. Don't forget, subscribe to the podcast, Apple Podcasts or Spotify. Do not miss future episodes. honestly, you can't miss anything we talk about because most likely all of this information will be on the final exam. Okay, so keep tuning in. There's some scary words for you right there. All right, we are out of time. Wow. Okay, for Professor Rick Plum, certified financial planner professional and accredited wealth management advisor, I'm your podcast host, Johnny Dean. This is Managing Your Financial Future. Thanks so much for listening. Talk to you all again next week. The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. Content in this material is for general information only and not intended to provide specific advice or recommendations for any individual. There's no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. All performance referenced is historical and is no guarantee of future results. The S&P 500 is a stock market index tracking the stock performance of 500 of the largest companies listed on stock exchanges in the United States. Indexes are unmanaged and cannot be invested in directly. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. CDs are FDIC insured up to $250,000 per depositor per insured bank for each account ownership category. Bonds are subject to market and interest rate risk if sold prior to maturity. Bond values will decline as interest rates rise. Bonds are subject to availability, change in price, call features, and credit risk. Stock investing includes risks including fluctuating prices and loss of principal. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. Roth or IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59 and a half or within 5 years of the date the Roth IRA was established, whichever is longer. Investments in real estate may be subject to a higher degree of market risk because of concentration in a specific industry, sector, or geographical sector. Fixed and variable annuities are suitable for long-term investing, such as retirement investing. Gains from tax-deferred investments are taxable as ordinary income upon withdrawal. Guarantees are based on the claims-paying ability of the issuing company. Withdrawals made prior to age 59 and a half are subject to a 10% IRS penalty tax, and surrender charges may apply. Variable annuities are subject to market risk and may lose value. Fixed index annuities are complex long-term investments designed for retirement purposes. Guarantees are based on the claims-paying ability of the issuer, subject to their terms and conditions. Withdrawals prior to age 59 and a half may be subject to a 10% penalty tax in addition to income tax. Annuities are not FDIC insured. Variable universal life. The cash value return is not guaranteed. If your investments perform poorly, the cash value will not grow as quickly and it could lose value. Fees are charged for life insurance and investments. There may be surrender charges and penalties for early surrender. Indexed universal life has caps on returns and no guarantees as to the premium amounts or market returns. An IUL insurance policy may be canceled if premium payments stop. Money market mutual funds, though traditionally lacking federal insurance, are not without risk and are highly regulated under federal law. Index mutual funds do not protect you from market ups and downs. Some index funds may have concentrated holdings. Index funds do not shield you from business or governance risks. In prolonged downtrends, index funds can perform poorly. The information provided is based on current laws, which are subject to change at any time. Lucia Capital Group is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at ssa.gov or call 800-772-1213 to speak with an SSA representative. Rick Plum is a registered representative with and securities and advisory services offered through LPL Financial, a registered investment advisor and member FINRA SIPC. LPL Financial Insurance License number 0518721. LPLIA Insurance License number 0B91442.